Greetings. This is the Advanced Projections monthly report for October of 2021. So our forecast highlights and reviews, we start out with about 5 bullets here. First, Delta infections and fatalities climbed noticeably during September as we predicted. Infrastructure spending packages have stalled in Congress, taking a back seat behind debt ceiling distractions. New employment gains have weakened considerably in August and September. Unemployment drops to below 5%, however, due to a surprise labor force contraction, dropping to a level that may portend changing Fed rhetoric. Finally, equities experienced a forecast decline in September, down 5%. It's been about 4 weeks since our September 2021 report. The Delta variant of the COVID virus has spread rapidly within the unvaccinated population of the USA. It still accounts for 99% of all newly identified U.S. COVID cases. Today, nearly half of the world's population has received at least one dose of some version of COVID vaccine, but those have been mostly in upper-income countries, and less than 1% of all doses have gone to the poorest countries. Now, about 56% of all Americans, or 185 million people, are fully vaccinated, with at least 75% of the age 18-plus population, about 209 million people, having received at least one dose of vaccine. New cases per 100,000 population moved deeper into the youngest half of the American age demographic, those 39 and under. Continuing entrenchment of anti-vax disinformation and politically and ideologically based resistance motivations have caused vaccination rates to slow to a relative crawl, even as the national virus death rate began to move well above 1,500 per day. Then, as we said would happen, last month, the daily fatality rate did surpass 2,000 per day during a portion of September. But it appears that fear of the Delta variant has begun to convince and coerce people and businesses that vaccination is the most certain route to protection from and the path to the end of the worst of the pandemic. So by the last third of September, daily case rates and fatality rates peaked and have just begun a slow decline. We're now again around 100,000 new cases per day with a small move below 2,000 daily fatalities. We hope to see a continuing decline in the weeks ahead, along with a stronger move towards getting at least 70% of all Americans fully vaccinated by the time we are into the holiday season. The large $3.5 trillion multi-year infrastructure restoration and improvement package, which had been negotiated in a bipartisan manner, and the $1.2 trillion portion for which we expected a rapid passage by the full Congress at the end of September, has been stalled within the congressional political quagmire. The new political hot potato was the debt ceiling and how to deal with it yet again, as many politicians and economists would like to see a demise of the ceiling, which was instituted over 100 years ago to appease budget hawks during World War I. A number of approaches have been put forth and discussed as a way to end its role of being sand in the political gears of the country. For the time being, Congress kicked this can down the road for just 2 months. It appears that it will be less visible for about 60 days and then pop up again ahead of a new December deadline. Artificially high year-over-year consumer price index comparisons and supply chain issues have continued to plague many aspects of the economy, keeping prices and inflation expectations elevated as demands remain above available supplies. CPI figures confirm the onset of inflation during the second quarter, with the CPI up a little less than 2% in just 3 months, and a 5.4% year number since the economic bottom last summer, in the year since the economic bottom. The Federal Reserve continues to claim we will see only a temporary step up of the inflation rate lasting perhaps 1 year or so. This does not mean most of the resulting price increases will come back down. However, the most volatile ones, food and energy, should eventually return to pre-pandemic levels as supplies are restored to normal levels, with energy prices being the later ones to come back down. At this point, year-over-year inflation appears to be set for an overall 6% bump in 2021. The party in equities continued almost unabated during August, with new index records being recorded throughout that month. However, a weak employment report for August triggered a little more caution in the early part of September. Additionally, margin borrowing by investors after 15 months of continuous growth fell an astonishing and significant 4.3% during July. Added in were the incipient worries about the potential for a U.S. debt crisis. So, markets began to pull back, with the S&P 500 at the end of September and the end of the third quarter about 5% below where it had begun the month. The current initial inflation numbers, along with strengthening employment numbers, could induce the Fed to first change their rhetoric, then their actual policies. Unemployment took a big dip down to 5.4% in July as nearly 950,000 jobs were added, but August's number was much weaker, just 25% of that July figure, yet set the employment rate down to 5.2%. By the end of September, employment had not firmed up. The overall September gains were dismal, at just 40% of expectations, with only 194,000 net jobs added. An unexpected 500,000 person contraction in the labor force artificially dropped the unemployment rate further to 4.8%. Throughout the middle of 2021, we have said there was no visible event on the horizon that would pierce the bubbles in the equities markets, but that great caution was still warranted in taking personally huge positions in markets which are outrageously risky from valuation standpoints. The Fed, the Treasury, and the popular financial press have continued to discuss how and when the Fed will begin lifting short-term interest rates above the current near zero. The unemployment level has now dropped below our guideline 5% trigger level for a change in Fed rhetoric. Look for that in the coming weeks should the jobs and unemployment figures reported today, October 8th, go without any major upward revisions. Several large investment houses, including Goldman Sachs, had already discussed or actually issued warnings about the overpriced equities markets during August. The 5% decline in the S&P 500 during September seems to be supporting those opinions. The weak employment report will likely add to market declines until we have a much clearer picture of third quarter corporate earnings and fourth quarter earnings projections. AP does not look for much optimism in either. Now here are the current underlying socioeconomic details. First, of course, the pandemic. It's still with us. It's an albatross around the neck of the country, the world, and all the economies. The more highly contagious Delta variant is now effectively posing the entire threat to all the unvaccinated individuals domestically and internationally. In U.S. states with lower vaccination rates, case and fatality totals again are on a rapid increase, and there is definitely a hard race between dangerous variants and vaccinations that has to be won if the COVID pandemic is to be concluded. The CDC had already stated there was a fresh pandemic amongst the unvaccinated in many areas of the country, with cases increasing at national rates we saw last fall, ahead of the very deadly third wave. In this past month, the average daily case rates pushed up from 150,000 to about 200,000 for a short while. Now we're back down just below 100,000. Total U.S. fatalities have reached over 715,000, up approximately 65,000 in just the past month. At the onset of July, the major accomplishment had been to reduce the daily fatality numbers down below 400 per day, entering an area of societal tolerance. Now, within early October, we still have over 9.8 million active cases, essentially existing just amongst the unvaccinated, and are likely to see fatalities not moving much below 2,000 per day again, because the fatality rate still sits in the vicinity of 2%. That rate times the active cases indicates that another 150,000 to 180,000 fatalities between September 1st and the end of the year. In the first month of that period, 65,000 of that estimate has already become a reality. This situation and the efforts being made to control it remain as significant challenges to the economic recovery which had been so encouraging just 3 months ago. Offshore, the situation continues to be dire in many places. Ongoing shortages of critical care capacities and supplies, vaccines for distribution, are attributable to errors in approach, planning, logistics, as well as manufacturing and distribution limitations. Globally, cases have reached 235 million, up 15 million in August. At this moment, actually up 15 million in September. At this moment, there are still about 450,000 new cases being reported daily. Global fatalities have now solidly reached past 4.8 million with a fatality rate of 2.2%. The fifth wave is at work everywhere on the globe, but appears to be entering an initial decline. So far, the existing vaccines appear to protect against severe illness from all the known variants, but the more contagious Delta variant is showing to be more harmful amongst the unvaccinated younger folks under age 45, more so than the initial 2020 variants of the virus. U.S. health officials have moved to provide booster shots to those at the highest risk, beginning with the Pfizer-vaccinated population. Johnson & Johnson should be next, possibly by November 1st, but still no solid news on a Moderna booster. It's encouraging to see that the pharmaceutical planners and developers are thinking ahead and anticipating problems rather than being months behind and having to react in a renewed emergency. Legitimate, simpler pill-form treatments are now emerging for those who have been unable or unwilling to avoid infection. The graphic fatality model that we have been using since it was created almost a year ago is shown within our report. We modify it monthly to illustrate the still real danger in letting the pandemic continue its havoc here in the U.S. At the beginning of March, we were still running above the original late 2020 projections in terms of actual fatalities versus the model. So we were waiting to see for another couple of months if the problem was truly being solved by the first vaccine rollouts. By mid-2021, that was demonstrated by actual fatalities declining well below the model's curve, and then finally flattening to just minor increases. That was confirmed in our July report. In August, we tempered our optimism and we adjusted our predictive model to incorporate the expected effects of the Delta variant via the orange boundaries in the right half of the chart. Now, with just 2 months of new data, the model has already reflected its predictive accuracy. Our upper curve is more pessimistic than ones which can be found elsewhere, but the lower bound is about where most other forward-looking models are now to be found. Major models were showing U.S. fatality totals to reach or exceed 750,000 by December 1st. Well, that's virtually guaranteed to happen, and we project the number to be closer to 800,000. This would represent a doubling of the number of fatalities here just since mid-January, a period of only 10.5 months. Now, we continue to hope for improved domestic acceptance of the vaccines, with some more rapidly expanding public implementation based on new pleas, incentives, and mandates directed towards those still holding out. Without the vaccines, U.S. fatalities would have exceeded 900,000 by mid-2021, based upon our being above the curve in the illustration in the first quarter. So nearly 300,000 lives were saved in a matter of a few months. Those benefits could and should continue to accrue from both health and economic perspectives. As the unwelcome turn of events caused by the Delta variant unfolds, it can still return us to a pretty unpleasant picture within just another month or two. Yes, the USA is still atop the total case and total fatality lists for the world. Optimists are seeing light at the end of the pandemic tunnel, but we still have to get through the winter season to know for certain and to see a new flattening of the current red fatality line within our model. Now, the rest of the current economic picture. In August, unemployment levels moved down to a national level of 5.2%, even after a tepid monthly gain of 235 non-farm payroll jobs. This was followed by an even smaller job gains number for September at just 194,000. However, there still remained 7.7 million unemployed persons, many now without the lifeline of extended unemployment benefits. 500,000 people have now taken themselves out of the labor market, stopping any search for work activities. This artificially dropped the September unemployment rate to 4.8%. We have always been anticipating that return to work gains would flatten out below a full recovery level. These new numbers are consistent with our view that job gains will slow, yet continue, and may still take another 12 to 18 months to erase most of the remaining job losses created by the pandemic. This view is still predicated on the assumption that a national infrastructure package will assist in providing an ongoing employment stimulus. A nominal level of 4% unemployment would be a target for the Federal Reserve to consider a gradual end to their highly accommodative interest rate and money supply policies beginning in mid to late 2022. We expect the new decline in unemployment below 5% will trigger a change in Fed rhetoric, signaling that we should expect to see an eventual end to their current accommodative policies and associated near-zero short-term interest rates. In August, equities market prices had powered ahead with more volatility, setting new index records and pushing deeper into bubble territory. S&P 500 earnings for the second quarter exceeded estimates for over 90% of the companies in that index. Second quarter earnings reports showed year-over-year gains for the S&P 500 up well over 40%, which was strong given the circumstances, but was hardly anywhere near the amount that justified the continuing leaps in equities prices over that same one-year period. So we have a chart from FactSet that shows almost 50% of S&P 500 companies have issued negative guidance for the third quarter. And another quote from FactSet from companies which have now reported third quarter earnings up through October 7th. So here's their quote. Supply chain disruptions and costs have been cited by the highest number of companies in the index to date as a factor that either had a negative impact on earnings or revenues in Q3 or is expected to have a negative impact on earnings or revenues in future quarters. Of these 21 companies, 15 or 71% have discussed a negative impact from this factor. After supply chain disruptions, labor shortages and costs for 14 of those companies, COVID costs and impacts for 11 out of the 21 companies, and transportation and freight costs for 11 out of 21 have been discussed by the highest number of these S&P 500 companies. End of quote. The robust growth of the first half of 2021 is now behind us, and new multiple realities are at work in the current environment. None of them will go away magically, but must be worked through over the next several quarters. With a much weaker employment gains picture and an as yet unknown third quarter earnings picture, markets are showing far less irrational exuberance than over the summer. The 5% equity index declines of September are likely to amplify during October if the following elements develop or continue: tepid earnings results and forecasts, a stalemate over the infrastructure bills, weak employment gains, rapidly eroding consumer confidence. Many of these are elements which are already incorporated within our APLI leading indicator component. And we also monitor margin borrowing, as it is one of our favorite tools for indicating speculative excesses in the equities markets. Heavy margin borrowing that is synchronizing with markets making significant new highs is a likely strong leading symptom for a market correction. The latest information on margin debt is from August of this year, shown in a fresh chart that we use from Advisor Perspectives. We had expected to see an increase during May, which did materialize at about 1.7%, and we claimed it was likely that June would also show another increase, which did come in at 2.6%. July was a surprise, however, with a drop of 4.3%, erasing the gains of the previous 2 months. This implied that behind the scenes, margin lenders were tightening requirements in anticipation of a correction and/or smart money that was deleveraging with the same kinds of anticipations. But in August, margin borrowing went back up a full 8%, right back to new all-time highs. This was rocket fuel for all the new index records being set in that month. In the past year, the markets have only taken one short-lived break along the way to nosebleed territory from the lows set in 2020. But a return to warm market levels would take the S&P down to about 3,400, and a correction to the mean would be in the 2,700s. We are about due for another such correction, as equities cannot continue to defy the logic of value gravity indefinitely. And several investment banks have now issued such warnings, amongst them Citigroup, Morgan Stanley, and Goldman Sachs. These statements, just as we said last month, should not be ignored. Now, last month, our warning came ahead of a 5% decline. We're saying this warning again, and we do expect a continuing decline during October. Some trigger for a real solid correction is usually required, such as a downward surprise in corporate earnings, which is becoming more likely, and or many banks reducing their exposure to market excesses through the deleveraging of speculators and margin borrowers. August's rebound in margin borrowing was a surprise, but we believe it is still in the process of topping out rather than continuing its unprecedented growth. As market losses materialized in September and will likely do again in October, margin borrowing figures should be on the decline again. Certainly, the renewed COVID emergency could also fall into the category of a trigger as well. This might take another month or two to develop, considering current situational tolerances and psychological resistances to vaccinations and social restriction changes. However, if the fifth wave continues to decline and really breaks down to go away, then this becomes a much less likely trigger. And we repeat our warning projection here now. History also suggests that equities tend to correct 10 to 12 months after the resumption of GDP growth, i.e. when a recession ends. That suggests a potential window for a correction in the September to November 21 timeframe, based upon our November 2020 announcement that recession 2020 had ended. September has already met that criteria, but the correction is not likely to stay so shallow or over so soon. Now, our other individual indicators. August closing value for the S&P 500 keeps our APSI indication in the red, with that index still blatantly in overheated territory. September's close was just a minor correction, and we are still in blatantly overheated territory, so that indicator remains red. One primary indication of the top-heavy nature in equities is in the ongoing spread between the S&P 500 and our metric representing the GDP. In a graphic that we renew every month, we showed that this narrowed to a trivial extent in September, as shown in our chart. We still see this as an indication that more of our money supply is still being directed towards speculative financial activities rather than into solidly productive activities for goods and services. An article published this week stated that there is now 1 to 2 trillion in value, we use that term loosely, found in cryptocurrencies, which still qualify as nothing more than pure speculation. I did say that correctly, 1 to 2 trillion in crypto. This AP chart illustrates what is more widely considered to be the Buffett indicator. We continue to show several growth rate curves, with the uppermost smooth curve delineating the boundary between a warm market and a hot bubble zone. We are still deep in the bubble zone above the upper smooth growth curve. Our return to the mean is the center curve, and if one were to use a return to the historical regression, that would put us deeply down to the second lowest curve, or about a 2/3 loss in the S&P 500. That regression history is based upon S&P 500 prices over many more decades than we feel are relevant to modern market analysis. Now, the next chart we have is market risk based on 4 indicators, again, courtesy of Advisor Perspectives. It continues to shout out how risky the U.S. equities markets are, using their own set of 4 market indicators with a similar philosophy to our own. The risk indicator average was 181% 2 months ago, 186% last month, and now sits again at 181%. Even after a full 5% S&P 500 decline. The risk in equities continues at all-time highs. The AP/MS money supply indicator remains solidly green as the Fed continues with their expansion of the money supply, having reached an estimated $20.78 trillion, up 7% since the beginning of 2021. The rescue and recovery stimuli clearly added further to the money supply earlier this year, and this was reflected in the final M2 numbers from the second quarter. Official third quarter figures for the M2 and our much vaunted velocity of money will be released later in October and will be reflected in our November economic update. Month-end prices for gold and rhodium kept our APPM indicator deeply into the red, but the ratio is finally declining per our longer-term expectations. Recent gold prices rose in early September, then fell with equities to retest support levels just below $17.30 an ounce at the end of the month. Silver followed suit, and by the end of September was down another $2 from $23.50 to the $21.50 range. Rhodium fell hard in mid-month, down to below $10,000 per ounce, and recovered only a quarter of its loss by the end of the month to $12,000 per ounce. Platinum fell in concert with rhodium to $900 and recovered to about $960 an ounce. Perhaps the APPM indicator will go to yellow within a year, or it may do so even sooner if a sympathetic move with an equities plummet occurs. The August leading economic indicators from the Conference Board, which are published in late September, improved solidly based on what was going on in August, and it pushed our APLI indicator a bit further into green territory. Now, we continue to expect slight but noisy improvements to these LEIs during the next few months, barring further serious COVID Delta effects. The Conference Board also maintained their improved outlook for the economic recovery and that we should expect a more robust recovery well into 2022, so our LEI indicator will likely stay solidly in green territory for many months. All of this is predicated upon the absence of any overwhelming equity market correction or a sudden worsening of unemployment during the upcoming months. Our APYC yield curve indicator continued green, now continuously for 6 months. The yield curve continues to move all on its own, maintaining a more normal shape with the short end firmly anchored near 0%, but the long end moving up over 20 basis points by the end of September. The APFD Fed indicator returned to green when the NBER finally recognized, far too late, the end of Recession 2020. Underlying financial system stability indices, which we also monitor and are calculated by the Fed, support the current green status as well. Now, the Fed still has little it can do with short-term rates to further stimulate should it become necessary. Greater asset purchases are its only remaining tool and would reignite huge increases in the money supply. If inflation pops up harder or longer than they expect, or if a further expansion of large speculative bubbles becomes worrisome, the Fed may be forced to react in the other direction, raising short-term rates, which would likely collapse the equity bubble and perhaps the crypto bubble as well, if it has not already done so under their own weight and imbalance, which is the more likely scenario right now. We maintain a cautious and very neutral stance here. The economy was coming out of its COVID lethargy as restrictions on business and social activity have been rapidly dropping by the wayside, and the barely noticeable fourth wave of COVID infections had already gone away due to widespread initial vaccination programs. That assumed that what was going on in the rest of the world did not push something unpleasant back into the U.S. via the Delta variant. Clearly now, that was being a bit too optimistic, as a fifth wave of great proportion came roaring through in the late summer. Market and investor anticipations of the ongoing return to normalcy may continue for many months, but increased dynamics and volatility should still be expected, especially if Delta does not rapidly decline. There are sure to be economic ripples from the September end of extended unemployment benefits and the eviction moratoriums. So in summer, Recession 2020 came and went a year ago. Our warning system clearly foretold of it in late 2019, but COVID came along and gave it a rocket-boosted start. Massive federal intervention ended it early and has subsequently fueled the last 15 months of rampant recovery speculation. 4 of our 6 recession indicators are now in green territory. Precious metals still show red, and the extremely risky equities markets also show red. We are moving into a period in which our standard 6 indicators can be relied upon again, but must be augmented by a direct watch of public health statistics, unemployment figures, GDP, velocity of money, and financial stability indices for several more months. Those are inherently less reliable short-term indicators of recession potential than the 6 AP indicators. Because of this real-time status outside the bounds of normalcy, we must maintain our next recession potential still at 30%. If equities plummet, that picture could change quickly. So our final note, we continue to maintain that this is an extremely risky equity market environment with the potential for significant and protracted drops or flash crash scenarios based upon the indicator extremes shown in our charts over the past several months. A correction of 25 to 35% could very easily happen before the end of 2021. Only those with the highest tolerances for risk and a time tolerance for protracted returns to break even should be speculating in the equities markets at these levels. The only recent moderating influence in this scenario was that the Federal Reserve stated their willingness to maintain its near-zero interest rate environment, and that continued to fan the fires of market speculation. Now that unemployment has officially dropped below 5%, their tune is likely to change, causing further angst in the markets. Well, that's our report for October. The month upcoming before our November report should be extremely interesting and dynamic. So we hope to have some good news and maybe temper some of the bad news by the time we release our report in early November. Have a great month. Stay safe and healthy. And please, if you haven't yet gotten your vaccination, we urge you to do so. Thank you.